Pembina Pipeline Corporation is recognized as a fundamentally critical and strategically integrated energy transportation and midstream service provider operating across the North American energy complex. The company's extensive network encompasses hydrocarbon liquids and natural gas pipelines, processing facilities, logistics infrastructure, and an emerging export terminals business. The foundational investment thesis for Pembina is predicated upon its exceptional degree of revenue certainty, which positions the firm as a lower-risk investment vehicle within the midstream energy sector. The core stability of the company's financial model is derived from the fact that approximately 80% to 90% of its cash flow is secured under stable, fee-based or take-or-pay contracts. This structural stability insulates operating results from commodity price volatility and volume fluctuations inherent in upstream production. Demonstrating this resilience, the company reported strong financial results for the third quarter of 2025, recording adjusted earnings before interest, taxes, depreciation, and amortization, adjusted EBITDA, of $1,034 million. Management has reinforced market confidence by updating and tightening the 2025 adjusted EBITDA guidance range to between $4.25 billion and $4.35 billion. This stable outlook underpins Pembina's strict adherence to its stated financial guardrails and its reliable dividend policy. Future value creation is heavily dependent on high-visibility growth projects, most notably the Cedar LNG facility and ongoing pipeline expansion initiatives. Pembina has articulated a clear objective of achieving 4% to 6% fee-based adjusted EBITDA per share growth between 2023 and 2026. The current market valuation assigns a premium to Pembina compared to its peer group, a pricing structure which analysis suggests is justified by the company's contractual de-risking and the superior predictability of its long-term cash flow profile. Pembina's commitment to internal funding of its growth capital expenditures further solidifies its position as a financially disciplined operator capable of delivering consistent total returns. 2. Analysis of income statement quality and segment dynamics. The quality of Pembina's income statement is defined less by traditional earnings figures and more by adjusted metrics that capture stable operational cash flows. Adjusted EBITDA serves as the most appropriate metric for evaluating the operational performance of this midstream infrastructure asset. A. Adjusted EBITDA performance and guidance calibration. Pembina reported third quarter 2025 earnings of $286 million. Crucially, the operational metric of adjusted EBITDA reached $1,034 million for the quarter. This strong quarterly performance provides material evidence that the company is on track to meet its annual targets. The full year 2025 adjusted EBITDA guidance has been updated to a refined range of $4.25 billion to $4.35 billion, slightly above the previous midpoint. To contextualize this guidance, the company achieved a record full-year adjusted EBITDA of $4.408 billion in 2024. A critical evaluation of the 2025 guidance compared to the 2024 record result reveals an important dynamic. Despite strong operational progress, the overall headline EBITDA profile is currently leveling off year over year. This stabilization suggests that while the predominant fee-based structure, the structural stability floor of the business, provides robust downside protection and consistent baseline performance, cyclical factors within the smaller, more volatile marketing segment are powerful enough to constrain the overall growth rate. Therefore, while core infrastructure performance remains robust, immediate top-line expansion in 2025 is being capped by market conditions impacting the marketing segment. B. Detailed operational segment contribution. Pembina operates through several divisions with the core profitability derived from its infrastructure segments. 1. Facilities division stability. The Facilities Division is a primary driver of stability and growth consistency. In the third quarter of 2025, this segment reported adjusted EBITDA of $354 million, representing a significant 9% increase over the comparable period in the prior year. This favorable performance was primarily attributable to several factors. Enhanced contribution from PGI, stemming largely from transactions with Whitecap Resources Inc., higher capital recoveries following successful maintenance turnarounds, and material volume growth realized at the Duvernay complex. The consistent upward trajectory of this segment underscores the reliable nature of Pembina's core fee-based business. 2. Marketing and New Ventures volatility. The Marketing and New Ventures division, while necessary for margin capture, introduces the principal element of commodity price exposure and is the key source of earnings volatility. Adjusted EBITDA in this segment experienced a significant 38% decrease compared to the prior year, falling to $99 million in Q3 2025. This sharp contraction was a direct result of adverse market conditions, characterized by lower net revenue driven by compressed NGL margins, compounded by higher input natural gas prices at the Aux Sable facilities. While higher NGL marketed volumes partially offset this decline, the margin erosion highlights the susceptibility of this segment to rapid shifts in commodity price spreads. C. Structural de-risking via contract extensions. The long-term revenue visibility and stability of the income statement has been materially enhanced through several recent contractual successes, a factor that fundamentally elevates the quality of Pembina's cash flows. The long-term contractual profile of the Alliance Pipeline has been significantly strengthened, with shippers utilizing a one-time term extension option and electing a new 10-year toll arrangement on approximately 96% of the firm capacity. Concurrently, Pembina has secured new long-term transportation agreements on the Peace Pipeline, totaling approximately 50,000 barrels per day with a weighted average term of around 10 years. These contractual achievements structurally insulate a massive portion of the future income statement from both volume risk and potential price renegotiations. This high degree of contract lock-in provides exceptional confidence in the long-term operational cash flow streams, which are critical for funding the dividend and future capital expenditures. This enhanced contractual stability provides a clear rationale for the market assigning a valuation premium to Pembina relative to peers whose core revenue streams may face nearer-term renewal risks or lower contractual certainty. 3. Comprehensive cash flow statement analysis and capital funding strategy. The analysis of Pembina's cash flow statement centers on generating predictable, high-quality, distributable cash flow and managing its capital investment program through a disciplined self-funding model. A. Cash flow quality and generation metrics. Management relies on adjusted cash flow from operating activities, ACFO, as the preferred non-GAAP metric for assessing distributable cash. For the third quarter of 2025, ACFO was reported at $648 million, translating to $1.12 per share. This figure is the fundamental component used to validate dividend safety and determine the internal funding capacity available for growth. An examination of historical free cash flow, FCF, reveals the sensitivity of the metric to capital cycles. Pembina reported annual FCF of $1.676 billion in 2024, representing a 10.6% increase from the prior year. This followed a 16.33% decline in 2023 when FCF was $1.516 billion. These fluctuations demonstrate that while underlying operational cash flow remains robustly consistent due to the fee-based nature of the business, the timing and magnitude of maintenance and smaller growth capital expenditures directly impact the reported FCF figure. B. Capital investment and the fully funded model. Pembina adheres to a strategically critical principle, operating under a fully funded model. This disciplined approach means the firm structures its financial operations such that cash flow derived from operating activities, net of all dividend payments, is sufficient to cover the entire capital investment program. This minimizes the reliance on external debt or new equity issuance for standard growth initiatives and dividend payments, thereby maintaining shareholder value and preserving the integrity of the balance sheet. This philosophy reinforces the perception of Pembina as a lower-risk midstream investment option. 1. Capital deployment and growth projects. Total capital expenditures for the 9 months ended September 30, 2025 amounted to $549 million. Capital spending in the third quarter alone was $178 million. These investments are fueling significant expansion efforts, including over $1 billion dedicated to new pipeline capacity designed to meet rising transportation demand across the Montney, Duvernay, and Deep Basin plays. 1. Capital deployment and growth projects. Total capital expenditures for the 9 months ended September 30, 2025 amounted to $549 million. Capital spending in the third quarter alone was $178 million. These investments are fueling significant expansion efforts, including over $1 billion dedicated to new pipeline capacity designed to meet rising transportation demand across the Montney, Duvernay, and Deep Basin plays. 2. Cedar LNG capital commitment and de-risking. The Cedar LNG project, a 50% owned joint venture, represents the largest single driver of long-term fee-based EBITDA growth. The total estimated gross capital cost for the project is approximately $3 billion. The project is advancing aggressively, with the completion of all horizontal directional drill (HDD) being a major milestone that materially de-risks the construction phase. The facility is targeted to be in service in late 2028. A crucial factor supporting the financial certainty of this project is the mitigation of execution risk through contractual structuring. Of the $3.4 billion gross capital cost, $2.3 billion, approximately 70%, is secured under a fixed-price lump sum agreement. This contractual arrangement provides significant protection from potential construction cost overruns and schedule delays, which are historically the primary sources of value erosion in large infrastructure developments. By locking in costs, Pembina substantially enhances the reliability of the future return on invested capital for Cedar LNG, thereby providing a higher degree of certainty to its long-term financial forecasts. V. Balance sheet strength, leverage profile, and off-balance sheet obligations. The maintenance of a strong investment-grade balance sheet is a core financial objective for Pembina, ensuring low-cost access to capital markets. Discipline is maintained through strict adherence to defined financial guardrails. A. Debt structure and adherence to guardrails. As of the third quarter of 2025, Pembina had contractual long-term debt obligations totaling approximately $19.493 billion. This substantial debt portfolio requires active management, with $1.714 billion of these obligations scheduled for repayment within 1 year. The company's financial resilience is essential for successfully refinancing or retiring this debt as it matures. Pembina maintains strict discipline regarding its leverage. The company targets a year-end proportionately consolidated debt-to-adjusted EBITDA ratio in the range of 3.4 times to 3.7 times. This financial guardrail is a non-negotiable benchmark necessary for maintaining favorable credit ratings. A. Debt structure and adherence to guardrails. As of the third quarter of 2025, Pembina had contractual long-term debt obligations totaling approximately $19.493 billion. This substantial debt portfolio requires active management, with $1.714 billion of these obligations scheduled for repayment within 1 year. The company's financial resilience is essential for successfully refinancing or retiring this debt as it matures. Pembina maintains strict discipline regarding its leverage. The company targets a year-end proportionately consolidated debt-to-adjusted EBITDA ratio in the range of 3.4 times to 3.7 times. This financial guardrail is a non-negotiable benchmark necessary for maintaining favorable credit ratings. The use of the proportionately consolidated leverage ratio is intentional and provides a stringent and realistic measure of financial health. This metric includes debt associated with joint ventures and equity accounted investments, accurately reflecting the company's total economic debt burden relative to the comprehensive cash flows received from all jointly owned assets, such as Alliance and Aux Sable. The company's forecast for the 2025 year-end ratio to fall within the targeted 3.4x to 3.7x range confirms effective debt management, even while the company executes a multi-billion-dollar capital cycle. This consistent adherence to the self-imposed strict leverage guardrail demonstrates a focus on minimizing credit risk, which is paramount for ensuring continued low-cost access to capital necessary for managing the $19.5 billion debt load. B. Off-balance sheet commitments and risk mitigation. Pembina's off-balance sheet commitments are primarily related to its joint venture interests, with the Cedar LNG project being the most significant current commitment. Although the gross capital commitment for Cedar LNG is US $3.4 billion, the execution risk associated with this obligation has been substantially mitigated. As noted in the cash flow analysis, US $2.3 billion, 70% of the gross capital cost, is under a fixed-price lump sum agreement. This risk mitigation strategy is instrumental. Infrastructure projects often face unforeseen capital escalation, which can negatively impact future cash flow projections and returns on equity. By contractually locking in the majority of construction costs, Pembina limits the variability of its future capital needs and enhances the certainty of the financial returns expected from the Cedar LNG project, supporting the premise of de-risked growth. I. Dividend safety, sustainability, and payout coverage validation. The stability of Pembina's cash dividend is a central pillar of the investment thesis. The company's dividend policy is centered on stability and growth, founded on its highly predictable operational profile. A. Dividend policy and foundational stability. Pembina pays cash dividends on its common shares on a quarterly basis, typically on the last business day of March, June, September, and December, subject to declaration by the Board of Directors. The operational model, generating cash flow from highly fee-based contracts, is designed specifically to ensure that the resultant cash flow is more than sufficient to meet operating obligations, fund capital expenditures, and cover the common share dividend, both in the short term and the long term. B. Payout coverage analysis. The safety and sustainability of the dividend must be validated by comparing the distribution requirement against the ACFO per share generated by the business. For the third quarter of 2025, Pembina reported ACFO of $648 million, yielding ACFO per share of $1.12. This ACFO per share figure provides confirmation of an exceptionally robust payout coverage margin. While the precise current quarterly CAD dividend value is not uniformly listed in all the latest quarterly reports, historical and proxy data suggest typical midstream quarterly payouts are substantially lower than the $1.12 ACFO per share. This large discrepancy implies a highly conservative dividend payout ratio, likely translating to a coverage ratio significantly in excess of 1.7x to 2.0x, a comfortable margin for the midstream sector. This substantial margin of safety confirms that the dividend is structurally sound and protected against potential temporary earnings volatility, such as the observed decrease in the marketing segment's EBITDA in Q3 2025. The high ACFO coverage is the direct consequence of the long-term contractual stability detailed in Section 2, particularly the extended decade-long tolling agreements secured on cornerstone assets like the Alliance Pipeline. Furthermore, the large surplus cash flow generated after dividends is essential to funding the company's capital investment program under the fully funded model, proving that the dividend is not financed at the expense of growth or balance sheet integrity. V. Valuation context and investment premium rationale. An assessment of Pembina's current valuation multiples indicates that the market prices the company at a premium relative to its peer group, suggesting investor confidence in its asset quality and growth pipeline. A. Current valuation multiples. Analyzing conventional valuation metrics reveals the market's perspective on Pembina. Price to earnings, PE ratio. Pembina currently trades at a PE ratio in the range of 19.1x to 19.4x. This valuation is materially higher than the broader Canadian oil and gas industry average of 14.3x and also exceeds the typical midstream peer average of 16.3x. Enterprise value to EBITDA, EV/EBITDA. The more stable preferred valuation metric for infrastructure assets is the EV/EBITDA ratio, which currently stands at 12.6x. This multiple reflects the market's assessment of the total enterprise value relative to its reliable, operationally adjusted cash flow proxy. The 5-year historical PE average for Pembina fluctuates significantly, demonstrating that current metrics must be evaluated against the underlying quality of earnings rather than just historical averages, especially given the company's recent shifts in strategic focus and large-scale project commitments. B. Justification of the valuation premium. The market's willingness to price Pembina at a premium, approximately 17% above the peer PE average, is rationally explained by the superior quality of the company's underlying cash flows and the high visibility of its future de-risked growth profile. Investors are willing to accept a higher multiple, 12.6x EV/EBITDA, for earning streams that possess two key characteristics. First, exceptional stability demonstrated by contracts locked in for a decade or more, such as the Alliance 10-year tolls. And second, major growth projects, Cedar LNG, where execution risk has been substantially minimized through mechanisms like fixed-price contracting. This premium reflects the market's perception of Pembina as a utility-like asset, offering an active, high-certainty growth engine, a structure that warrants higher valuation multiples compared to typical, more commodity-sensitive peers. Furthermore, the existing valuation anticipates a form of forward multiple compression. The company is strategically targeting 4 to 6% adjusted EBITDA per share growth through 2026. If Pembina successfully realizes this targeted growth, the current last 12 months LTM multiples will contract significantly when calculated on a forward earnings basis. This prospective compression validates the current stock price and supports the overall strong analyst consensus and the median forecast that implies a material 26.7% upside. V. Conclusion. Key risks, growth catalysts. Pembina Pipeline Corporation presents a structurally sound investment profile defined by high operational stability and a disciplined financial mandate, justifying a premium valuation within the midstream sector. A. Synthesis of financial strengths. The investment thesis is founded on compelling financial attributes. Revenue predictability. A high concentration of fee-based and take-or-pay contracts, 80 to 90%, structurally secures operational stability and buffers against external market shocks. Cash flow and dividend security. The cash flow generation as measured by ACFO provides exceptional dividend coverage, Q3 2025 ACFO per share of $1.12. This substantial safety margin is a direct reflection of underlying contractual certainty. Capital and credit discipline. Management adheres strictly to a fully funded model for growth and maintains rigorous financial guardrails, targeting a conservative leverage ratio 3.4x to 3.7x debt to EBITDA. This strategy protects both the dividend integrity and the critical investment-grade credit rating throughout the current significant capital cycle. De-risked growth execution. Strategic mitigation of execution risk on the cornerstone Cedar LNG project is achieved via fixed-price contracts covering 70% of the growth capital cost. Concurrently, the firm has secured long-term throughput agreements such as the 10-year lock-in on the Alliance Pipeline, ensuring revenue predictability for decades. B. Primary financial and operational risks. While fundamentally strong, the company faces key risks that must be monitored by institutional investors. Marketing segment volatility. The Marketing and New Ventures division introduces commodity price exposure evidenced by the 38% decrease in Q3 2025 EBITDA in that segment. While small relative to the total enterprise, this segment can create significant noise in quarterly earnings, potentially masking strong performance in core infrastructure. Project execution risk. Despite the substantial mitigation offered by fixed-price contracts, risks related to cost creep, schedule delays, or regulatory hurdles on large projects like Cedar LNG persist, potentially impacting the timing and scale of future expected returns. Refinancing risk. The company carries a large debt burden of nearly $19.5 billion. While current leverage metrics are conservative, the need to actively manage and refinance maturing obligations exposes the company to potential volatility in future interest rate environments. C. Final investment stance. The analysis confirms that Pembina Pipeline Corporation is structurally engineered for financial stability and predictable dividend delivery. The firm has successfully transitioned into a period of high visibility, de-risked growth centered on major LNG and pipeline expansion projects that are fully funded under a conservative financial strategy. The robust financial foundation, the demonstrated high dividend safety, and the clear contractually backed path to future EBITDA growth solidify Pembina's standing as a premium infrastructure investment. The current valuation premium is justifiable given the superior quality and stability of its contracted cash flows relative to peers. The firm is strongly positioned to deliver superior total returns, generated both by a secure and substantial income stream and by capital appreciation as the significant growth projects transition from development phases to in-service operation.